Hello, I'm Shinichiro Kasai, strategic real estate advisor based in Japan. Japan's latest construction data shows a 1.2 trillion yen output. It looks like growth. But in reality, the situation is complex. It's not just a growth. It is severe polarization driven by cost inflation and shortage of labor. First, I'll let AI to summarize key data points regarding structural shift. Then I will return to share my strategic conclusion on how investors navigate the era of selection.
Hey everyone, welcome. So today we're diving into Japan's construction market. And if you just look at the headline numbers, you think things are absolutely booming. But there's a much more interesting and complicated story hiding just beneath the surface.
So that brings us to the big question, right? Is Japan's construction market really booming like the numbers suggest? To figure that out, let's start with the official data, which, I gotta say, looks pretty darn good at first glance. And just look at this. We're seeing solid year-on-year growth pretty much across the board. Total output is up almost 5%. The private sector is doing even better, up over 5.5%. And the public sector is looking healthy too. I mean, on the surface, this looks fantastic, doesn't it? But what if I told you that growth is kind of an illusion? Yeah, to really understand what's going on, we have to look past the sticker price. We need to talk about something called the construction cost deflator. Now, this right here is the key to the whole story. The construction cost deflator is basically a special index that strips out the effect of rising costs for things like materials and labor. It helps us see the difference between how much money is being spent versus how much actual building is getting done. You know, are we actually building more or just paying more for the same amount? And this slide just lays it all out perfectly. The top line there, that's the nominal growth, the total amount of yen being spent. And yeah, it's going up. But look at the bottom line, the real growth. The actual physical amount of construction is basically flat. That huge gap between them, that's inflation. It's not that we're building more, it's that building itself has just gotten way, way more expensive.
This quote just nails it. The expansion we're seeing in the market isn't because more people want to build things. It's an illusion created by sky-high costs. And that has huge consequences for who can even afford to get a project off the ground these days.
And this cost pressure, well, it isn't hitting everyone equally, not even close. It's actually creating a massive divide in the market, with some very clear winners and some very clear losers. So on one side, you've got the service sector. Think about it. Tourism is roaring back, there's a huge push for digitalization, and these guys are investing like crazy. Orders from non-manufacturing industries are up a whopping 17%. But then, you look at the other side of the coin. The real estate industry is slamming on the brakes, hard. Orders have plummeted by over 24%. I mean, the contrast between those two figures is just wow. It's staggering. And when you put it all together on one chart, the split becomes crystal clear. You got the service sector booming while manufacturers are getting nervous, and the real estate developers, they're hitting a brick wall of costs that makes it almost impossible to start new projects. And here's where it gets really weird. It's a paradox. The business sentiment among those same real estate developers is actually super high. They feel great about the properties they already own. But ask them to build something new? No way. They just can't make the math work with today's insane costs. Now, this whole situation isn't just about money. It's causing a fundamental power shift in the entire industry. And it all boils down to one critical problem, a chronic shortage of labor. Think about it like this. It used to be a client's market, right? Developers had all the power and contractors would compete for their business. Well, with the shortage of skilled workers, that dynamic has completely flipped on its head. Now, the contractors are in the driver's seat. They're the ones who get to pick and choose. So who do they end up choosing? They're pretty much forced to cherry-pick the high-margin projects or the trustworthy clients. In other words, only the developers with really deep pockets, the ones who can guarantee a big, profitable project, are getting anything built. So when you put all these pieces together, what does it all mean? It means the market has fundamentally changed. We've officially entered the era of selection. We've moved away from that old model of quantitative expansion. Just build more, sell more. That's over. We are now firmly in an era of qualitative selection, where only the very best, most profitable, most bulletproof projects can actually survive.
And this is the new reality. The biggest barrier to entry isn't having a great idea anymore. It's being able to tolerate these crazy high costs. This makes prime locations and high-end properties even more precious because they're so scarce. Meanwhile, that old model of just building tons of low-cost housing, that's basically going extinct. And what's taking its place? A growing focus on renovating the buildings we already have.
And so that leaves us with one final big question to think about. In this new, tougher environment, this market of selection, what is it that truly defines a winning project? What's the magic ingredient that separates the buildings that get built from the blueprints that just end up gathering dust? All right, that's a wrap for today. If you found this explainer helpful and got something out of our dive into Japan's construction market, do us a favor and hit that like button and subscribe for more. It really helps us out. Thanks for watching, and we'll see you in the next one.
The market is shifting from quantitative expansion to qualitative selection. This means that the developers is pulling over on new projects due to soaring costs. This means the value of existing well-maintained stock in prime location will rise. But at the same time, the maintenance cost is also rising. So do not buy blindingly. So you need to verify the physical condition of the asset. So thank you very much for watching and see you soon. Bye.